very happy 2025. A new year means new resolutions, but it also means resetting the financial performance meter to zero. So let's look at the landscape for bond investors. Their two main aggregates are giving conflicting signals. So what should they be looking at? We have interest rates that are at an attractive level in many economies, but we also have spreads that are very, very low. In other words, the difference between government and corporate bond yields is currently small. There can be two reasons for this difference. Either government yields are too high or companies are in an excellent health. As far as government yields are concerned, we should remember that government debt has been soaring. We have budget deficits, not to mention growing political instability. In Europe, we are even seeing a convergence between the countries of the periphery, which have carried out their reforms, and those of the core, such as France and Germany. The same trend can be observed in corporate bonds, and the Novartis bond maturing in 2028, denominated in euro, is currently yielding less than a French government bond with the same maturity. The low spread levels should therefore be seen in the context of the deterioration in government debt, which should make corporate bonds immune for some time to come. So they are benefiting from this trend, although there is no real distinction between the quality of the company's balance sheet. Investors are buying bonds with much higher coupon than in recent years, and even if volatility rises, these higher yields will provide a cushion. But does this mean that the market has gone blind and is buying everything and nothing? No, not really, because investors are still paying attention even amid the frenzy start of the new year. Concession premiums, which is the extra yield offered on a new bond, have fallen average from 8.5 basis points in 2023 to 3.5 in 2024. They were just at 2.1 basis points on January 6. So demand has fallen as a result, with bid to cover ratio going from almost 4 times to less than 3 times at the start of this year. Another indicator of the trend is the withdrawal of orders when the terms are revised downward, what is called attrition. While this was only 18% in 23, this has risen now to 24% at the start of 2025. Brazil's GBS experienced this firsthand when it issued a 30-year bond with an initial announced premium of 195 basis points. Following the success in the order books, the spread was tightened to 162.5, so 32.5 compression, which resulted in a negative concession premium of minus 7.5 basis points. Faced with this new price, many investors pulled out, and 62% of the order books evaporated. The secondary market reacted reasonably well, but the bond failed to catch fire, confirming the increased selectivity of investors. The new bonds issued on January 7 avoided the extreme seen at the beginning of the year and have already improved the market's receptiveness. A reassuring sign that there are opportunities to be seized, but not at any price. Thank you.